Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Today, we will bounce around quite a bit. There's a lot to discuss. The market is moving extremely quickly the last few hours, and some of what we talk about now might be invalidated by the time this video is released. But we do need to discuss the market. We'll look at Bitcoin, we'll look at bond yields, we'll look around the rest of the crypto space and see what's been unwinding, and just kind of generally discuss what's going on. There's a lot of emotion out there. There are a lot of people concerned about what this market is going to do and where the bottom might be. And that's very difficult to know. But what we can do is lay out the data, try to form a cohesive narrative about everything that's happening, and prepare ourselves for any number of possible outcomes. So that's what we're going to do today. We're going to talk through the data a little bit. It'll be kind of a free-flowing video and hopefully sets us up for things that could be happening this week. If you enjoy my content, make sure to give this video a thumbs up and subscribe to the channel. Now let's get into it. Well, it's hard to know the best place to start today, so we'll just start with the Bitcoin monthly chart. Here, over the last 12 hours or so, we broke below the low that was set in mid-May during the Luna collapse, and we're now down here around 24,000, which is the lowest we have been since the bull run in late 2020. Now, we explored, if I go down to the weekly just to see this a little better, we explored in the last video how there isn't really a lot of support down here. We've got this 200-week moving average, which a lot of people use. When you look at where it's currently positioned around 22,000, there really isn't any structural price support here, right? Like the previous all-time high from 2017 is down here at 19K, 19.8. But then in this range here, this like low 20s, there's almost nothing structurally that we can look back on monthly or weekly timeframes to provide any real support. I saw my buddy Blockchain Backer talking about this. He put out a video really early this morning, and I think he made a couple of great points that we'll touch on here, and they relate to this 200-week moving average, which I know a lot of people point at. A lot of people feel like it's a really good structural support because every time we've interacted with it in the past, it has tended to be at like the pico bottoms of bear markets, and we're super close to it here, right? We're within a couple $1,000s. But what BCB pointed out, and I think is really important for us to note, is that the 200 weeks previous catches when it's worked out have been very near structural support. I mean, if we just kind of zoom in on this area here, you can see that where these wicks came in as they broke below the 200 week really lined up with where we got closures on this initial all-time high in April of 2013. So it wasn't just the 200 week that was providing support, but also some actual structural price action. Same thing over here when we look at 2019, 2018, when we broke down and we saw this touch of the 200-week moving average, it really aligned with some structural consolidation from back here in July of 2017, when we kind of did this pullback and then another breakout on the way towards 20K. We also came back and back tested it here. And this little area provided nice support, and that lines up with where we touched the 200-week moving average. So yes, it has been very effective, but it's also often aligned with previous areas of resistance. You can also kind of do that here as well from March of 2020. It's really not that far away from places where we had seen previous price action, at least chopping around and looking for support. But the thing is, over here, we don't really have that unless you go all the way down and you start talking about the all-time high from 2017, which is at 20K. So where we are right now is a little bit of no man's land. So the 200 week, I don't really look at it that much. I thought that this point here from Blockchain Backer this morning was really good, and I wanted to roll it into what we're looking at here. But there is another metric that's in a similar place to the 200 week that it's worth looking at, and it's the realized price, which we see up here in this orange line. We've talked about this before. It's an on-chain metric. So the realized price is the price at which all coins last moved on-chain on the Bitcoin base ledger. So when you think about the realized price, it's like the cost basis of the entire supply. And when we look back through bear markets, the realized price has been like a floor that is ultimately broken through in all previous instances. Those instances are in these red red ribbons up here at the top. These are times when price was under the realized price. And when you have those moments, you can think of Bitcoin as being in loss in the aggregate. There's more supply in loss than in profit. Right now, the realized price is at 23,400. And where we are right now, this morning at time of recording, price is at 23,900. So we're just a few $100 above the realized price. And it has been broken in all previous bear markets. Down here at the bottom, these triangles represent streaks of time spent above or below the realized price. Just a different way of visualizing it. And when you look back, you can see we've had these long stretches of growth. This one ended 876 days after it began. The longest one was from 2016 to 2018. It was 1,123 days. We're currently at day 816 from when we last broke above the realized price, which was back here in 2020. And we spent a week below it. That's the shortest trip that we've had below it, not counting some of these random little like one-offs that were part of a larger move. But in terms of just a clean break below, 7 days was the shortest. That was March of 2020. So will we get another week below the realized price? Will it be longer? Hard to know here, but we do have historical precedent that we should spend at least a few days below there if history is meant to repeat itself in any kind of way. And you know, it makes sense to me that we would touch the realized price. It has happened in every bear market so far. And when you think about the logical representation of it, the fact that it's the cost basis of the network, it would make sense that when Bitcoin goes into a contractionary period, that it would come down and at least test the support of that level. We hadn't gotten that yet. A lot of people had been calling bottom at various points over the last few months, and there's just always been something tickling in the back of my mind that just didn't feel right without us at least testing the realized price, at least getting close to it, because that is a place where a lot of people said that they would become a buyer, right? It's probably the most watched floor metric in Bitcoin. There is the 200-week moving average. We know that's a big one, but the realized price is a really effective floor model for Bitcoin because it makes logical sense. The network is either in profit or in loss. And by the nature of its popularity, that means we're now at a place where a lot of market participants claimed publicly that they would become a buyer. So we get to see now if they have enough support to help push us out of these lows, if this maybe can help catalyze a bear market rally. I know a lot of people want that. I'm not calling for that, and I probably wouldn't try to, not in this environment. But if you're looking for conditions to allow for a bear market rally, a crisp, clean test of the realized price could be that. Like I said, we're very close. We're within $400 or $500 of the realized price as of now. And by the time you watch this video, that information might be out of date. Things are moving quickly here this morning. And on the subject of things moving quickly, so here you can look at Ethereum. Ethereum is now below the 2018 all-time high, which is a pretty impressive fall when you think about how strong this bull run was and how unlikely people thought we would see $1,200 or $1,300 Ethereum again. Well, here we are. It's now down below the previous all-time high. Will it bounce? Hard to say, friends. This is not a market environment where bounces are plentiful. Just look at the bleed. You know, here's Ethereum over the last few months. Just look at the endless bleed. This was the only real rally to speak of, and it was extremely ugly. It barely broke above the previous level, and then we just cratered straight down. You know, Bitcoin doesn't look too different from this. Same thing if we go over here to total 3. So this is the crypto market cap minus Bitcoin and Ethereum. So it's all the other shitcoins. And you can really see, look down here, this is also now below the 2018 all-time high. Now this market here, this altcoin market has really had a lot of excess hanging out for a long time. And when you see this kind of a bubble get created, it's just a matter of pure physics that it needs to come down and test some kind of previous support in some way. You know, that's just basic market structure. A lot of people didn't want it to happen. Maybe there was a thought that it wouldn't happen yet. You know, a lot of people had a theory along the way that we'd pull down, get some kind of wicked retrace, and then we crash. Well, we never really got this retrace, and perhaps one unfolds later in this process than we expected. It's hard to say right now, but without really getting that clear, clean retrace, I mean, this is hardly a retrace. What we saw here in March, that's barely qualifies. I mean, if I throw a Fibonacci retracement on here, this retrace never even got back up to the 50% mark. So by historical standards across really any asset, that barely qualifies as any kind of a retrace or bear market rally. It's barely a bounce. So getting one down here seems unlikely based on the momentum to the downside that we're seeing here. And there are other risks in the Ethereum ecosystem. So my buddy and colleague Checkmate over at Glassnode, he posted this tweet yesterday, and he's been keeping a track of how the Ethereum market cap compares to the market cap of the 3 largest stablecoins. So his line of thinking here is that the Ethereum ecosystem has well in excess of $100 billion worth of leveraged loans and collateral. And stablecoins are often the product of that borrowing. And when you have the market cap of those stablecoins worth more than the asset they're being borrowed against, it creates serious liquidation concerns. Now, it's not a one-to-one. A lot of what Tether, USDC, and the Binance USD get used for is not necessarily leveraged loans on just Ethereum. But since we don't have that layer of detail here, just comparing the market caps can give us a general sense of how fragile that ecosystem might be. This purple line represents the market cap of the top 3 stablecoins combined compared to Ethereum. Back here in January, it was close to 0.3. Here at the beginning of May, the ratio was 50%, half and half. Well, it's now shot up here to 0.8. That means that the 3 largest stablecoins have 80% of the market cap of Ethereum. That was as of yesterday when he posted this. Now, he also said Ethereum at 12.15 makes for equal Ethereum and top 3 stablecoin market caps. Well, Ethereum is at $1,230, friends. It's basically at the level that Checkmate was talking about over here, where the top 3 stablecoin market caps would equal Ethereum in market cap. That creates serious solvency risk for leveraged loans backed by Ethereum that are borrowing stablecoins. And when we see what's going on this morning with Celsius, where they've paused all withdrawals, swaps, and transfers between accounts, straight up locked out their customers, there is a major risk of liquidation across the DeFi space. You know, people in the Bitcoin community have been calling for folks to take their coins out of Celsius now for the last couple of months because the writing was on the wall that they had solvency concerns. Well, it seems like over the last day or two, they're really beginning to unwind. This is not a space where I feel like I'm super well informed. I don't know all the ins and outs of DeFi, but it really does seem concerning to me that the Ethereum market cap could be possibly flippened by the very stable coins people borrow with Ethereum as their collateral. So this is something that you should have, on your plate of awareness here over the next few weeks. And we do have quite a busy week. Things that are normal economic releases have been magnified in importance as we sit in this critical phase of the market. Things like core retail sales and crude oil inventories, which are normally not items of huge importance and huge interest, become really relevant at times like this. So this week we've got PPI and core retail sales. We've got both the Empire State and Philly Fed manufacturing indexes. We also have FOMC, where many people expect the Federal Reserve to raise the target rate by 50 basis points as they have promised, though there are people calling for a surprise 75 basis point hike. Part of the reason people believe that's possible is because bond yields have been utterly ripping. Just take a look at the 10-year here, finally breaking above a 2018 high, which is the first time it's done anything like this in over 40 years. Yields have been on a 40-year trip to lower highs, and we are finally seeing that paradigm shifting a little bit here. Does this mean that the Fed has more room to tighten their policies, to raise interest rates even higher than people expect? Well, they may try to do that, and then the market may swiftly invalidate them. When you see the 10-year breaking above a previous high like this is the kind of belief-shattering catalyst that could really pull the tide tide back in the market and show us who's swimming naked. We could really find out where the cracks lie in the foundation when you see a multi-decade trend breaking down in the markets. The significance of bonds breaking out in this way, particularly the long bond, the 10-year, the significance of this cannot be understated. This is something people believed simply couldn't happen. So the way that the market chooses to react to this is hard to read. But what is certain is that this puts pressure on debt, sovereign debt, private debt, corporate debt, you name it. Everything is under pressure here. And seeing this kind of a thing may start to reveal to us where the weaknesses truly lie in this market. Feels like people are watching 1,000 different things, wondering which facet is going to start to crack and tremble first. Is it the corporate credit markets? Is it the sovereign debt markets? Is it labor? Where is it going to first start to unravel? We may begin to see that here very soon as the Fed is vastly behind the curve on raising rates, and they're trying to make up for it at a very tricky time. I mean, when you look over here, this is the Japanese yen versus the US dollar, and it's currently threatening a 20-year breakout. This level right here is from January 2002, and it's trying to kiss a possible breakout here. We are in an unprecedented type of market. All those factors really combine to tell me that it never really felt reasonable that Bitcoin had already bottomed. It was plausible. Certainly, it's possible that when you see a strong wick on high volume, that maybe that means it's a capitulation, big wick on high volume. But as we explored on this channel numerous times, a strong wick on high volume doesn't always mean the bottom is in. Just last summer, it did not mean the bottom was in, yet people continue to point to things like this. And it's wishful thinking. It shows a lack of understanding of the macro environment and that Bitcoin is very much a macro asset that is moving with the world economy. This is an undeniable truth. If you go to shorter time frames, you can find divergences and edge, but on a big picture, everything is correlated to one. So what we need to watch this week is see what happens with equities. We're 20 minutes from the open of the US market. Here are the futures right now. And this is where Bitcoin was when futures opened yesterday afternoon, and it has just been on a straight elevator shaft down. Same thing with the S&P, same thing with the Dow, same thing with the NASDAQ. They're all just on a straight staircase downward. And continued lower equity prices are likely to continue having downward pressure on earnings expectations. We're already hearing rumors about earnings revisions being lowered, which is shown here on this blue chart. You can see them coming back down, though they're still well above, a negative contracting period. We are seeing earnings revisions fall, which is important to point out because just as recently as a couple of weeks ago, Bloomberg was showing that analysts largely had a consensus belief that earnings would still be double digits in the second half of this year, over 10%, which feels untethered from reality to me. There seem to be a lot of companies out there that still believe they're going to pull out a miracle this year, and they're going to be able to maintain profitability, they're going to be able to clear their inventories, continue to have full staff, and it's going to be a normal year. But some of the biggest people in the space that we've talked about together here, Walmart, Target, Amazon, they're all expressing tighter margins, excess inventories, and if we start to see earnings estimates fall, and those things actually manifest next month in July in lower earnings for Q2, then the labor market could begin loosening quickly. Which is important because sentiment is at the lowest point that it has ever been historically by the University of Michigan's Consumer Sentiment Survey. And it's at the lowest it's ever been while unemployment is also at basically the lowest level it's ever been, within a few decimal points. So we have the lowest unemployment rate that we've ever had, and we know that that metric is flawed. However, we have the worst consumer sentiment that we have ever had, which means that people, consumers who are the workers in America, consumers are not feeling good. Their margins are being squeezed. They don't have as much spare income as we have unpacked at length on this channel. Real incomes are down. Real wages are not keeping up with inflation. Sentiment is in the gutter, yet unemployment is very low, which means that there is not a lot of room for sentiment to get much worse when employment starts to skyrocket. It's already very bad. People are already pushed to their limits. And if they start losing their jobs, we could have a serious crisis situation on our hands. People's savings are already being vaporized by high inflation. Rents are up 30 and 40% in some places. Rent. Those are people who do not own their homes and they have not benefited from elevated housing valuations. They're just getting rinsed, yet we still have relatively full employment. So that's a major red flag to me. If we continue seeing equities deteriorating and it starts manifesting in July in lower Q2 earnings, then we may start to see labor loosen up very quickly, and that could bring a little bit of pause to the Fed. It could at least make them second guess their policies because they keep referencing tight labor as one of the reasons why they want to march forward. And when we look at labor and we see how quickly unemployment can begin to reverse, how quickly it can rise, the fact that it's very low doesn't really say a whole lot about future expectations because it can change very quickly. And it's in part kind of miraculous that we've been able to maintain such a tight labor market when we're seeing clear weakness in the consumer across a number of financial metrics. So this week, definitely got my eye on equities. As we talked about, we have a ton of events unfolding. We've got producer prices, retail sales, we've got crude oil inventories, a couple of PMI surveys coming out, and the all-important FOMC on Wednesday, where the Fed is likely to raise 50 basis points. If they did 75, it would be a bit of a surprise. I'm not sure that they'll do that. But nonetheless, the press conference afterward is always must-watch TV. So we'll see what Powell says. We'll try to break apart any little learnings inside of there, and we'll talk about it afterward. And, I know a lot of you out there would like me to provide you with some kind of a price expectation. You want me to tell you that I think price is going to go lower, or it's going to go higher, or it's going to stay in this range. And I am deliberately not talking about where I think price is going to go because I don't want that to be our focus, because I think that's misguided. I don't think that anyone out there can tell me where price is going to go and have any kind of believable data behind them, because there is no analog for this market. Will price hit the 200-week moving average? Will it hit the realized price? Will it come down here and hit the previous all-time high? I have no idea. One or all of those things could happen, and we could still have a very tight labor market. We could still have overblown housing valuations, and we could still have a Fed that believes they need to tighten because inflation has not materially improved, even though they probably can't do anything about it short of causing a major recession. So price targets are simply not important right now. I also think it's extremely prudent that everyone makes sure they have plenty of cash savings, that you've got a buffer to protect yourself in case you or your partner loses your job, in case your living expenses suddenly balloon because of factors outside of your control. It's really hard to know what we could deal with over the next few months, but what I can say with almost certainty is that we've not seen the end of this yet. Nothing that has happened yet is the kind of thing that is going to force the bottom of the market. We're still seeing credit deteriorate. There is still a very tight labor market, and there are still people out there buying the dip and believing that the Fed pivot is right around the corner. Well, friends, the Fed is not going to pivot quickly unless something deteriorates quickly. That is just the truth of it. So there's no way that we could be talking about the bottom yet. In equities, in Bitcoin, in credit, you name it. And that's just the way that it is. That's the way that these market cycles unfold. It's not meant to be doom and gloom. I'm not trying to cause fear. I'm trying to be blunt and honest with you. And when you think about what it would take for the Fed to turn the liquidity spigot back on when we still have 8.6% consumer price inflation, it would have to be something traumatically bad that broke. And none of that has happened yet. So we will continue to observe. We will continue to be patient. And as data rolls in, we will analyze it and try to assess how we think it will affect the markets. But we will not get cute with price targets, with calling bottom, with saying that the bull market's back on. I'm not even keen to try to establish if we're going to get a bear market rally, because when you look at the price action and you see the way it's just absolutely cratered here, I mean, this has been basically the only kind of move up we've had, like we saw on Ethereum as well. And this barely qualifies as a retrace. So it's really difficult for me to see any realistic scenario where we have some like crazy rip, even if it comes back down. The momentum just doesn't appear to be there. The trend is clearly down, and there is no way I'm stepping in front of that train. Make sure you follow me on Twitter at TXMCTrades. I post a lot of my thoughts and analysis here. Many of them make it into the videos, some do not. I'm also pretty active. I try to reply to folks and engage so we can have a little bit of a social interaction. I love hanging out on Twitter. This is a very important week. We've got the FOMC in a couple of days. We've got retail sales numbers. And we're witnessing a potential unwind of leverage across the crypto market, catalyzed by Celsius. There are risks to the Ethereum ecosystem as they are now down below the all-time high from 2018. Bitcoin is currently threatening the realized price around 23,400. I know we bounced around quite a bit today. Many of the things we discussed might feel scary, might feel overwhelming, but what causes stress for me is not having an idea of what's going on. So it's really helpful for me to talk through this data with you, to help try to formulate some ideas as I talk through it, and to keep our finger on the pulse. That's what helps me manage my own emotions and manage my stress, because not knowing what's going on just causes my imagination to run wild. So we'll continue to have an eyes wide open approach to this market and be humble and patient. If you have any questions for me or feedback for this channel, if you found my content valuable or you'd like me to talk about some other topics in a future video, please feel free to share your comments below and I will see them. I approve all the comments for my video manually. And that is where we will leave it today. I want to get this video out before too much of the day goes by because I fear that some of it may be outdated by the time you watch. The market is moving that quickly. So please, take care of yourselves, friends. Don't make any rash decisions. DCA if you find value, but don't do it in a way that risks your financial solvency because we don't know what's coming up ahead. And it's important that all of us have a defensive positioning here. So that's really the place that I'm coming from today. We will allow the market to unfold and talk again in a couple of days, a little bit later this week. So until then, be kind to each other, take care of yourselves and your families, and we will chat again very soon. Cheers, everyone.